obviously we're watching the market give way each day, and we're looking at the bigger factors out there. And it does appear to us, yeah, that we could be in for a bit of a retrenchment in the markets just based upon fundamentals. I mean, you've got increasing energy costs. That's going to cause increasing inflation. You've got further decoupling going on in the global economy as a result of the war in Iran. I've got interest rates actually going up quite a bit, and that's going to have to filter through the economy, and that's going to have a very strong negative effect on the overall economy, given the indebtedness of the economy.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Today, we have the good fortune of being joined by Jonathan Wellum, who is the founder and CEO of Rocklinc Investment Partners, which happens to be Thoughtful Money's endorsed financial advisory firm up in Canada. Jonathan, thanks so much for joining us today.
Great to be with you, Adam. You've picked a great time for me to talk with you, given what's going on in the markets here.
Yeah, it's not like there's a shortage of things to talk about. I also want to thank you. When this video, we're recording it the day before Thoughtful Money's spring online conference, but it's going to run the day after, and you're going to be an important part of that conference. So I'm thanking you in advance while we're recording, but retroactively after this launches, for your involvement there. It is going to be, I know at this point in time, I'll feel comfortable saying it was a phenomenal event. And just want to remind folks, if you didn't watch it, but you wish you had, don't worry, you can still purchase a replay of the conference, folks. Just go to thoughtfulmoney.com/conference and you can purchase the replays there. All right, Jonathan, like you said, a lot going on in the world. And I kind of want to make that part of the thread we talk about here, which is, I think about that Rudyard Kipling poem, If. I should have pulled it up here. I don't have it in front of me, but it's like, if you can keep your head while all those around you are losing yours. I think this is one of those times in the market, or it feels like it's about to be one of those times, where there's so much concern swirling around here for very understandable reasons, whether it's what's going on in Iraq, whether it's what's going on in private credit, whether it's people just watching their portfolios start to shrink here. If they've been, natural resource holders, especially in the precious metals, they're watching those get kind of clobbered right now. I think the only people who are doing well are those who own oil and gas stocks at the moment. But how do you help people kind of just keep perspective and keep from being their own worst enemies at this time? Because we know that most investment decisions that are made out of emotion tend to be the wrong decision at the wrong time.
Yeah, great question. And that's really what, as advisors, that's how we really earn our keep. I'm talking to our guys in the office today, and I said, this is when we actually really have to work hard and to keep the long-term focus. So we go back to why we are invested in the various areas that we're invested, why we own some of the businesses that we own, why, for example, are we in precious metals? And has the thesis changed at all? Just because there's some circumstances that are, causing a disruption in the markets right now. And so we always go back to looking again out 2, 3, 4 years where we want to be and look at the underlying reasons for investing in these sectors and in the particular businesses in the first place. We have to stay focused. I've been doing this for 36 years, almost 37 now, believe it or not. And I've seen tremendous volatility, back in 2008. I remember I should say, 2008, there was a financial crisis, but even to go back to 1998, long-term capital management, we had a lot of financials. And they, Merrill Lynch, I think, went from like $80 to 25. And you got to look through the long term. Of course, the Nasdaq peaking out in 2000 and so forth. So the issue is, when you're investing, why are you investing? What's the thesis? Is it still intact? Can I take advantage of the volatility to dollar cost average and actually increase my positions? And for goodness sakes, don't be buying high and selling low. That's what is really condemns a lot of retail investors who aren't focused. So that's what we do. We just go back to our basic thesis, look at the valuations, and just stay focused.
Okay. One of the things that I think a lot of retail investors are guilty of, and folks, I've been guilty of this too many times myself, is we tend to get an insight, right? Whether it's we've actually done our homework on a specific company, or we are reading and we think we identify a macro trend and think, okay, this company is going to benefit from that, right? So we're pretty good at coming up with like a rationale for buying a security. We're not great at the same time in our mind determining, okay, well, under what conditions are we going to sell, right? Our just general hope is, okay, I'm going to buy this thing. Hopefully my thesis is right. It's going to make me a lot of money. And then at some point in the future, I'll have more money. you know, yeah, maybe I'll sell it, but we don't really, there's not a framework or a formula that we're putting together to say, okay, if it hits X within Y zero amount of time, or if this change happens macro, that's going to be my trigger. We just kind of think, well, in the future, I'll figure out when to sell it, right? And then we get into a point like this where there's just a lot of uncertainty there, and we look at our portfolio, and we all of a sudden realize, yeah, I'm not really sure why I own half the things I have in here. Right? I felt passionate at the time I bought it, but like I'm not sure how I feel about it now, and I don't know whether it's worth keeping in the portfolio or not. So this kind of goes back to the old, know what you own um, maxim in investing, and this is one of the reasons why I recommend people work with financial advisory firms like yours, is because you guys don't have the luxury of just buying and crossing your fingers. Your every decision you make you have to justify to everybody else at the firm and your clients why you're buying it. And then you kind of have to justify it on a daily basis why you continue to hold it. So you know why you're holding it or why it's time to get rid of it. How do you help the average person there who is just looking across their portfolio and seeing a whole bunch of names where they're just like, I don't know if I want to be holding this going into further uncertainty, but I don't know if it's a bad time to sell or not.
Yeah, I mean, part of that is upfront education. So making sure that when clients come in, they understand that there will be volatility. We tell clients, so look, if you're not prepared for a 30-40% drawdown on some equities, I mean, not that we want to go down that much, of course, but whenever you buy something, you can get a drawdown like that if you don't have a stop loss in place and so on. And so we try to prepare clients for some inherent volatility that will emerge. You also, when creating a portfolio, make sure that you have some assets that aren't overly volatile so that if they need money in the short run, they can take from that part of the basket, if you will. And so asset allocation is very important. Along with that, if you do have a sector like precious metals that has run quite a bit, like very quickly, that's a sector you want to take some money off. So take a little bit of money, take some profits, reallocate it. That's a discipline that's very important also. And then a sell discipline as as you basically are laying out there. If if the thesis change gets overvalued, better opportunity, you sell the security. The security doesn't care if you own it or not. It doesn't have, there's no love relationship between you and a stock. And so you got to be able to part with it when it doesn't make sense. And so again, all of those factors come into managing a portfolio, managing expectations, and managing the risk in the portfolio.
All right. I mentioned some big concerns that are swirling out there in the headlines right now. I'll get your opinion on them in just a second. But there's one development that I'm curious how concerned you are about it, which is if you look at technical analysis, one of the factors that people look at a lot is daily moving averages, and they have started to cross over to the downside. And pretty much as of the day we're recording here, Jonathan, we've punched down below the 200 daily moving average. It's looking like we're probably likely going to close there. TBD was going to happen next, but a number of the folks I talked to sort of they see that as a critical support level. And so the question is, we'll find out. We don't know for sure at this time, but we could potentially be on the precipice of a fairly large coming down leg in the markets because we've punctured that long-term support. How concerned are you about the fact that we are now below it?
Yeah, I mean, to be honest with you, we don't spend a lot of time on technical analysis. We're bottoms up, value oriented investors. I mean, clearly we also look at some of the macroeconomic trends. So that's not something that we're preoccupied with. Having said that, obviously we're watching the market give away each day, and we're looking at the bigger factors out there. And it does appear to us, yeah, that we could be in for a bit of a retrenchment in the markets just based upon fundamentals. I mean, you've got increasing energy costs. That's going to cause increasing inflation. You've got further decoupling going on in the global economy as a result of the war in Iran. I've got interest rates actually going up quite a bit, and that's going to have to filter through the economy, and that's going to have a very strong negative effect on the overall economy, given the indebtedness of the economy. You've got just so many geopolitical factors going on and uncertainties right now in terms of the Strait of Hormuz. There's so much important economic commerce goes through that. Not just the 20% oil, but you've got fertilizers. You've got the issues with natural gas now that have been interfered with, the LNG facilities in the Middle East. So, I mean, there's just a number of things that I think are weighing on a global economy. It's already really leveraged and didn't really have a lot of growth anyway. Outside of the United States, I mean, there's not a lot of economic growth in Europe. There's very little in my own country, in Canada. And so when you look around the world, if you put these kind of headwinds in the system, the increasing interest rates, the increasing energy costs, which are going to filter through, and increasing inflation, and so on. I think to see a global recession can all of a sudden becomes quite probable. I mean, I'm not calling for that, but these things are going to be big concerns. You mentioned private equity, private credit. We're seeing all sorts of issues bubbling up to the surface there. In my own country, in Canada, we just did a quick report in the private real estate market in Canada. So about $80 billion has been raised over the last number of years. So multiply that by 10 if it's in the U.S. economy. We're about 1/10 sort of the U.S. So 80 billion was raised, and these are private real estate equity funds, and 40% of them are gated. 40% of that are gated.
Wow.
And so again, you're seeing this pressure coming, and people don't talk about it that much. You're seeing some of that in the United States, some of the gating that's going on, but the gating is there because again, they don't have the liquidity. People want out. They want out for a whole host of reasons. Quite a few of the funds that have been gated have cut their distributions. And a lot of people bought these strictly for the distributions and maybe a little capital upside. And what comes next, Adam? Probably write-downs, right? And so, so there's all of this swirling around, I think, that is concerning, and I think is going to put a lot of downward pressure on economic growth, not just, of course, in the United States, but around the world. And so I think that's why the market's really, really getting heavy. It's tough going. We've had a lot of excess. You've talked about this, the lag effect. Maybe we're finally getting it in the market. And so I think people need to tighten their seatbelt and get ready for some volatility, increased volatility, and maybe some downside for a while.
Okay. And what's interesting is there's a lot of angst around this right now. But the markets are down, what? A little over 400 points from their all-time highs. I mean, it's not a lot, and there's a lot of room. There's a lot further to fall, right? So if people are freaking out now, I wonder if there is another down leg like we're talking about, what the fear factor is going to be, on Wall Street at that point in time.
Yeah, I mean, if you look at the TSX in Toronto, we're now just negative for the year and probably off about 4 or 5% from the high. And as you know, in the U.S. market, the Nasdaq might be down 5-6% year to date or so, and the Dow is just a little bit less than that. So yeah, we're not very far off the highs, and people are very concerned. But I think that's just because of the overall environment in the world, the unsettledness that's going on. There's just so much activity. Every time you turn around, there's things taking place, and I think it's just sort of throwing people off. And it's unsettling. People are just not settled, I think, in terms of their stations. Yeah.
Well, so at the conference, the keynote was provided by Lacey Hunt, and he, as he usually does, he does a graduate level walkthrough of a whole bunch of charts about our current situation. And this conference, it was all about studying how oil shocks have impacted economies in the past. And, in particular, when an oil shock happens, when the economy is already somewhat compromised. And, the short answer, folks, is nothing good, right? And so, Jonathan, we could have, and we were talking about a number of the concerns that you and I have rattled off here so far before the war was enacted against Iran. And not only does the war itself put an uncertainty premium on markets, but obviously what's been going on with oil prices is the real big concern. It's sort of like, hey, we had an issue, or we had a environment that we were quite worried about beforehand, and now we have this exogenous shock that is quite bad. There's no real good way to spin it. How much more vulnerable is that going to make the fragile system that we had before? And of course, the big answer to that is sort of twofold. It's, well, how long does this war last, right?
Right.
And then secondly, how much damage is done to the Gulf energy infrastructure? And that's
Exactly.
been, I think, the very concerning development this week is that both sides have started hitting, um, oil and gas installments that will take, honestly, months at best to get working again. And in a number of cases, they're saying years, right? And of course, that's what's been done so far. Who knows how much is going to be done going forward? So there's this big uncertainty factor out there still of just how much more could this be, right? How much more damage could it be? How much longer could the war last and these high oil prices sustain? So, you try to sort of see all the different permutations of what could happen and come up with a probability distribution, but it's hard to find many parts of the tail that don't have some sort of quite negative lingering effect from what's going on right now with this war.
Absolutely. I mean, look, we've been facing, the end of a debt cycle. I mean, we were in a huge debt cycle. We've got an issue with currencies, our whole currency system. You've got this major political struggle going on now in the Middle East and all of the implications of that. You now got a jacking up of energy costs at a very vulnerable time in the global economy. And as you point out, it doesn't appear that those energy costs are going to come down that dramatically soon, simply because there's been some damage and the world can absorb some of this, but if you've got the LNG facility in Qatar has been hit, that they're talking maybe a couple of years for parts of that to get back up, and so the energy assets in Iran are compromised. Other parts of the world. I mean, you take a couple million barrels of oil off the market, and it can have a profound effect. But that runs through, as you know, every part of the economy. Every part of the economy now is going to be increasingly stressed. Also, at the same time where you're having this, bipolar world being developed, right? So at the same time that we're kind of getting east and west, in my view, we see, that sort of, building now, that sort of China, United States, and the sort of the standoff there. That means, again, all of these goods that are coming from the east to the west, probably less. That means increasing prices, probably, things like that. So there's so many things going on that I think can feed into inflation or stagflation environment and that are upsetting for people. And we just don't know how this is all going to pan out. I don't know how it's all going to pan out. That's why when we come back to our investment thesis, we stay pretty focused on some of the precious metals. We stay focused on businesses that we think, can absorb this pressure and continue to do well and so on. And also we're trading at, attractive prices so that we're not overpaying. But no, it's a world that's facing a lot of challenges and they're all coming to a head. And then you throw this mess of increasing energy costs into the middle of it all. And yeah, it's one that's I think investors have a reason to be concerned and to be focused on what they're investing in and be watching their capital.
Mhm. So obviously, this was a big topic of conversation at yesterday's conference, and I'm saying yesterday, even though we're recording it the day before. But I've seen all the presentations, and you know, when you get a whole bunch of people together, you're going to have differences of opinions, right? That's what makes a market. But I will say, Luke Roman um, is very concerned about all this, and made the comment that he is concerned about an outcome that, in his words, could be worse than COVID plus 2008 combined, which is a pretty big statement. And I'm not trying to freak everybody out. And I'm not saying you have to share that as well, Jonathan, but I'm just mentioning it to say, hey, some of these smart people are really concerned about what these knock-on effects could be. Um, Let me ask you a question, maybe to the positive upside here, at least for part of the world. I asked Lance Roberts this in yesterday's weekly market recap, but I'm curious to hear your thoughts too, especially because you're from Canada. Um, I think even if the war ends tomorrow, but especially if it lasts for a lot longer and gets worse, is um, I think the risk premium to purchase oil and gas through the Persian Gulf is going to be substantially higher in the future than it has been up until this war. Um, it's going to be more expensive to insure ships. Countries are going to be, once bitten, twice shy. I'm not really sure I want to do this in case my tanker gets marooned inside the Gulf if they close the strait again, or God forbid gets hit by a missile or whatever, right? If Iran decides to, if the regime is still intact and it starts to try to, enact a toll of any ship going in and out of there, which apparently it's maybe starting to do now. So we've all heard the stat that 20% of the world's oil, flows through the Persian Gulf, as of right before the war. I'm one man's opinion, but I'm going to guess that percentage of the world's oil that the Gulf represents is going to go down, or at least as a ship through the Gulf is going to go down for two reasons. One, I think, and apparently we're already starting to see this. You've got countries saying, you know what, I think I want to start buying a larger percentage of my oil from quote unquote safer, friendlier parts of the world, right? It might be Canadian oil, it might be US oil, wherever. And so I think our countries could potentially be net beneficiaries of that. And I understand that some people watching this might not like that. Maybe it looks like war profiteering or whatever. But I think that could be one of the outcomes of here. I also think, and we've heard talk of this too recently, a lot of the countries that are on the coastline there in the Gulf will be working even harder, and a number of them have already built infrastructure to do this, is to provide alternative ways to get the oil and gas out of their country and getting it onto a ship without having to traverse the Gulf, right? So these are pipelines that are going, to the Red Sea or to other potential distribution points. So my point here is I think no matter what happens, the Gulf's output's probably going to be a bit diminished. It's going to be more expensive. And other parts of the world will probably benefit. And of course, other parts of the world too it's a reflexive system. They'll say, hey, look, the world wants to buy a lot of oil, but not from the Gulf. Well, we'll increase our production here and we'll sell to them. So do you see this? Because I know you're very resource oriented in your, the types of companies that you invest in.
Yeah, no question. I think we're going to see dramatic changes take place. An event like this really sharpens people up. I mean, it's also coming at the same time, Adam, as you know, where we're getting this sort of deglobalization, right? In other words,
Right.
I think Trump has really been pushing this, that we're, too dependent on China, too dependent on an enemy or someone that's not exactly your best friend, someone you can't trust, and becoming much more independent in terms of all of your resources from a Western Hemisphere perspective. So I think it's going to play right into that very, very well. And you're already seeing that. I mean, you had some of the government officials over in Japan cutting deals on energy and so forth, so that they can bypass some of the Middle East and the Persian.
Yeah, just to that point, it wasn't just Japan, but we just struck a deal for the U.S. did for 56 billion for a number of Indo-Pacific countries, including Japan. So I think that if you listen to the administration and trust them, they're saying basically the phones are ringing off the hook right now.
Yeah, and I'm up in Canada. I'm just salivating at that of what you guys are doing, because in Canada we've got so many resources, but we have the incompetence and lack of initiative on the part of our federal government in particular, but also some of our provincial governments to develop these resources. So I mean, we should be getting much more LNG out of our country. We're doing some small deals. But a few years ago, the Europeans came to us, the Japanese came to us, came to our Prime Minister Trudeau at the time, and he said there was no business case, if you can believe it, no business case. And so, but I think that's going to change. There's going to be so much pressure, and hopefully the current leadership in Canada or new leadership will recognize that ability, because Canada, especially for the US, we should be developing stronger relationship with each other, because we have all of the resources. Anything you don't have, we do have, and we're right next door. And it's much safer, of course, and it's all within the hemisphere. So uranium, potash, of course, natural gas, the years of development we have in our oil and gas sector is much larger than the United States, and so on. Lumber, aluminum, because our energy costs, because of hydroelectricity in Quebec and some of our provinces, is just so low. It's a fraction of the cost that you're going to have in the U.S. But we can smelter the aluminum as I say, at a fraction of the cost. These are things that we need to start thinking about and developing. But of course, you need the intellectual horsepower and people to want to do that, right? But no, I think it's going to change. It's going to change quite a bit in the world. Having said that, with all of these changes, as you know, Adam, that changes the world, and it causes increase in prices and dislocations for a period of time. And I think that's what the market's worried about, that we could, again, it's fine to say we're going to change our distribution model, but we're used to a pretty efficient one right now That's being interrupted. Now we're going to have to replace it with something else. That means increased costs, increased infrastructure costs, and just all of those changes that will have to take place. And I think, again, that's why the market is looking at this and going, oh, no, this could be inflationary for a little while. And without a lot of economic growth, that could be stagflation. And we might not get, we might not advance very far. And this could be a serious problem. And then with all the debt, how do we pay for the debt? The interest rates go up, as you know, every 1% increase in the interest rates in the U.S. is another 390 billion in interest costs. Who pays for that? So, I mean, again, you go back to Luke Groman's comments. I'm sympathetic to what a lot of what he's saying, simply because the numbers do not add up. You can't have a $39 trillion debt, unfunded liabilities, a budget bringing in a little over 5 trillion, spending 7 trillion. You got a war that's going to cost, they say, a couple $100 billion, but I think the last time they said the Iraq war was going to be what someone said, half a trillion, half a trillion or so, 500 billion, turned out to be $3 to $4 trillion. Where does all that money come from, right? So again, when you add all that up, you're sitting there thinking, yeah, you're going to be concerned. You're going to be trying to protect your capital. There's no question. There's a lot of uncertainties.
Okay. I want to ask you in just a second about, the potential, well, given this outlook, what an investor should be thinking, but also how they can position themselves for sort of the period after, where hopefully once most of the change and volatility and pain of the system is bled through, sun's going to come out again, and there may be some really good opportunities to own some great companies at good valuations. Real quick though, let me just ask, because you have the Canadian perspective, and I'm not asking you to speak for all your countrymen or even speak for yourself individually, but what is the tenor of what America is doing in Iran right now? Is it, hey, this is the right thing that needs to be done, and it's unfortunate, but I hope they succeed? Or is it, what are these crazy cowboys just gotten the world into?
I mean, my view, I'm as you know, more sympathetic to what the U.S. is doing. Again, I don't know all the ins and outs and the information that the Trump administration has to pull the trigger on Iran, but it's been a very bad, global player and a real problem for the Middle East and uncertainty. I think overall in Canada, it's a little more of a liberal. It's a bit more, in your terms, democratic, if you will, versus Republican. And I think I'm fairly accurate in saying probably the majority of Canadians would not be overly supportive of the U.S. going into Iran, but there'd be a good sized constituents that certainly would support it. So I think it would probably be somewhat of a split. We've got a large Iranian population in Canada that is overjoyed with it, of course, and want to see a change in terms of the government there, because of the revolutionary government there has just been absolute butchers. I mean, these are just awful, wicked people. So, but I think overall, to answer your question, it would be a mix. It wouldn't be overwhelmingly in support, and there'd be certainly a lot of people that wouldn't like it. And some of that I think is fed by Trump derangement syndrome. Him poking
Sure.
around.
And Trump earned the ire of the Canadians. I mean, there's no.
and there's a bit of that going on, unfortunately. There's nothing I can do about that. I try to encourage the relationship. I think the United States is our most important trading partner and most important country that we need to be friends with, and we should continue to work on that front. In fact, our leader of our opposition, Pierre Poilievre, was just down in the United States recently. Just did the Joe Rogan show, and again, is just trying to get that more conservative message that sometimes doesn't get out about Canadians. That we are sane, sensible people in many regards, and we do want to work with the United States. A lot of us do, and we've got a lot of great resources. So let's get a deal and continue to work to both of our advantages going forward.
Yeah. Well, and it's interesting. So this will be a conversation for a different time, but Canada very resource rich, and so is the U.S. And we're entering this period of time where both self-sufficiency's got a higher priority on it for countries, but also there's a lot of countries that don't have abundant resources. Japan being a great example when it comes to energy. And the US-Canada powerhouse, if we are able to find ways to continue to work even more closely together, you can make an argument that there could be the dawn of a really new, exciting era for that partnership going forward. But let's save that for a different day. So to my my question that I sort of half-asked earlier. Um, I'm not saying this is going to happen, but assume for a moment that things do get worse from here. Um, uh, you know, or maybe I shouldn't even start with that, but like, given the current situation, what is your firm's general advice to the average investor? So what you're about to say isn't personal financial advice, and we all know that what matters is your own personal situation. So, folks take this with that disclaimer. But is this a time to start, uh, increasing cash reserves if you haven't started already? Is it time to be sort of positioning for the potential of a material correction? But then also, if you've positioned well, then you have the dry powder to deploy when there's better valuations around.
Yeah, I'm reasonably comfortable with some of the weightings that we have, given what we're seeing right now, and that means we do have up to 25%, close to 25% that's in fixed income, very short term, short duration, investment savings type, money market type funds. So we do have liquidity, and that's larger in people who are closer to the wire or are retired, things like that. So we have higher, fixed income portfolios, allocations for them. For folks that are younger and continuing to add to their portfolios, I think as we tell them, this could be a wonderful time. I mean, we get volatility, you can dollar cost average, and you can invest more in the marketplace. So we've tried to position our clients, sanely, rationally long before something like this emerges. And sometimes we'll get the feedback from clients, hey, I want to be more invested in the market. I mean, can you increase my allocation? And that we say, just wait a second, just be patient. Because when things are going up, they all want to be 100% invested. When they're going down, they want to be zero invested in the equities, right? And so again, it's trying to find that balance and just hold people's hands, in a sense that you give them again a good rationale for their asset allocation. So we're pretty well positioned now. If things get really messy, we certainly go through and look at different clients that maybe we should have a little more cash, and depending on their aptitude and their risk tolerances. But most of our clients that don't want a lot of volatility, they're already positioned really safely and carefully before anything like this happens, because we know anything like this can happen at any time. Out of it can always come some exogenous event can hit the market. That's this of course has been a little more telegraphed, if you will, but sometimes you can have a real shock hit the system all of a sudden, and so investors have to be prepared beforehand. That's part of building a portfolio, part of I guess coming to an advisor and earning our keep, if you will.
Okay. All right. And then specifically when it comes to precious metals, they've had a lot of volatility right now. I want to ask you your thoughts on their direction, but I guess before I do, from a volatility standpoint, do you have any general advice for the precious metals investor? Is it a time to lighten up? I doubt that's going to be your answer, but is this a time to think about hedging? What are your general thoughts?
Yeah, I mean, a couple of things. Of course, it depends how you're positioned. If you were way overweight in the sector and it's way too much volatility for you, maybe you should trim back a little bit. I'm bullish long term, but I'm only saying that so that you can have a sane, and good night's sleep. So sometimes people just get overweighted, and I think sometimes it's better if they just take some off, even if they're going to, sell at a price where they might have a small loss at this point. But I mean, if they were investing in this sector, they probably still have fairly large gains if they were, in a disciplined way investing going over the last couple of years. So a couple of things. So nothing wrong with taking a little off if you're overweight and you're really nervous and you're, just can't sleep. I mean, people are, some people, they just can't handle the volatility. I think what we're trying to tell people though is that, look, if you have a reasonable weight in it, I mean, maybe it's 20% of your portfolio, and they're in great companies like Franco-Nevada or Wheat Precious Metals and some of the ones that we own, Agnico Eagle and things like that. Just stay tight. Don't be jumping around. These companies are trading at very attractive prices. If you look at the gold price right now, for say 4,600, and you look at sort of $70 silver, some of these companies like Agnico Eagle are trading at, an 8% free cash flow yield if that price holds up this for this year. And Franco-Nevada and Wheaton Precious Metals are trading at 5 and 6% free cash flow yield. So they're reasonably priced. And then what we try to get people to focus on is that we have an intractable debt problem. I mean, the global monetary system is under massive pressure. And so you want to make sure that you're keeping a certain percentage of your portfolio exposed to this area. And, just know the companies that you're in, make sure they're strong companies, make sure they're going to take advantage of volatility in the price also, and that they're continuing to grow their portfolios. When we look at the companies that we own, whether it's Agnico or Franco, Wheaton, and Cisco royalties, I mean, there's a number of them there. They have, in many cases, it varies, growth rates, but over the next few years, they're seeing 20, 30% growth in, in gold equivalent units and so forth. And so there's strong growth there, along with, I think, opportunity for price increase. So it's stay focused on the fundamentals, know what you own. If you bought something that's speculative that, is just gone up because everything went up, yeah, you're going to be nervous. If there's no foundation to what you own, there's no balance sheet, and there isn't resources being developed, then of course you should be nervous. But you probably shouldn't have bought that in the first place. So you want to be very careful and maybe lighten up on some of the junk and make sure you're in high quality.
Okay, well said. And also, there's a fair amount of talk about gold at the conference, no huge surprise. But several participants, especially Rick Rule, were saying that even at today's precious metals prices, right, which are off the highs, silver particularly so, um, even if they just stay here at the prices you mentioned, right, $4,500 gold and $70 silver, that in general, the miners are, in their opinion, underpriced given the jump in profits that these companies are going to see. A lot of these companies are still being valued as if gold is like 3,200 versus 4,500. And in particular, Rick was saying that the royalty sector, which doesn't have exposure to operating costs, right? So, the rise in oil, it doesn't impact the guys at the royalty companies. He said they look particularly underpriced right now. And he actually went through and shared a whole bunch of names that are on his radar list. So again, folks, if you want to find all that out, go buy the replay for the conference. But Jonathan, you're nodding as I'm saying all this, so it sounds like you feel similarly.
Yeah, no, absolutely. They're great businesses, and as you say, their costs don't go up. They're just going to get a percentage of the royalty, or they'll get a piece of the stream that comes off of them, as you know. And I think the other thing that Rick probably pointed out, which I think is 100% on track, is that again, this AI, digitization, all these long-term trends, they remain. I'm not saying that you should go out and buy NVIDIA. We don't own it, but I'm just saying that that those trends and need for power and energy and copper and so forth, those are going to continue to develop. And I think that a lot of these resource companies are going to look to some of these large royalty companies like Franco and Wheaton and Royal Gold to do more of their deals. We just saw this about a month ago with Wheaton Precious Metals providing $4 billion in capital, $4 billion royalty. I mean, it's just a massive royalty. And so I think there's more of these coming down the pipe, which will provide great opportunities for some of the larger royalty companies. It was thought for quite some time that they're out of deals. There's no deals to be done, but their cost of capital is so low and it's such an efficient model that they can come along and they're really the best providers of capital in many of these large projects, especially a lot of the copper projects. So I think there's a lot of different opportunities for them to grow, even if the price of gold and silver and copper just go sideways for a while. That's fine. Again, we get too caught up with people saying, silver is going to go to $500, it's going to go to $400, $500. You hear these different things. Maybe it does. I'm not attacking anybody that says that, but if they can make lots of money at 70 and you can do your models, if it goes to 500, hallelujah. But you can still make lots of money even at these current prices. And so when you look at silver, for example, again, the demand for that versus what's produced, there's a shortfall. There's been a shortfall for 5-6 years. It's needed. It's a strategic resource. It's becoming even more important in the future. So all of these things give me a good reason why I want to be in some great companies that can profit from it over time. And yeah, there's going to be price changes. There's going to be volatility. You have to stomach that if you're going to make a long-term return. But buy high quality, know what you buy, and buy them at attractive prices. And I think you can do exceptionally well over the next number of years because of, again, some of these long-term trends that I'm going to continue to bet on because I think they're just really large secular changes that are taking place in the world. If they don't take place, then that's a different story. But I think it's hard. Some of these trends are hard to reverse, and I think they're inexorable trends that are moving forward. Especially again, some of these the need for power and digitization, AI, robotics, all of these things are continuing to have a big influence on the materials market.
Okay. All right. Well, look, in starting to wrap up here, Jonathan, before we turn the camera on, we were talking about an issue that's sort of near and dear to your heart. And I will say elements have been woven into conversations I've had on this channel, over the past, I'd say probably a couple of years. I want to give you an opportunity to talk about it because I think it's particularly important right now. Well, and I'll explain why in just a moment, and I don't want to put words in your mouth, so you describe this any way you like, but it's important to you to kind of look at wealth building and the pursuit of a good life, we'll say, through a moral lens and not just a financial one. So elaborate on that.
Yeah, I mean, many years ago, I have a theology degree, so I do have a master's in theology actually. But I wrote a master's thesis on John Rawls' theory of justice. Actually, back in the he was a big shot at Harvard and wrote a big tome on justice. But what in going through that study and also studying theology, you realize that it's really the virtues and values of the culture which underpin everything else, the political system, the economic system, the cultural system, and so forth. It's really those values. And there was one book that I came across that was excellent. It's called The Economy in Mind. And it's written by Warren T. Brooks. It's a number of essays from Warren T. Brooks, who was an accomplished author and writer in newspapers through the 60s, 70s, and 80s, was quite instrumental, I think, in the Reagan administration. But he had a couple quotes in that book, which I think are really important for financial people to remember, because we get caught up in numbers and looking at resources. And sometimes we don't step back and say, well, really, what's the first order of importance when it comes to developing economy? So he has one quote I'll just read you, I think, which summarizes quite a bit of this. He says, "The primary and essential character of wealth is metaphysical, not physical, and is the direct result of the creativity of mind, not the availability of raw materials. The sum product of individual efforts, not the manipulated static resources of collective nations or governments or lands." And what he's really saying there, especially if you read the book in more detail, is that this whole issue of virtues and values and innovation and creativity, if you don't have that first and foremost, you're not going to develop the resources of your land. And we see that in country after country, countries with lots of natural resources. It doesn't mean they're rich if they don't develop it and they don't have innovation and creativity. One of the powerful forces in America, 250 years going from a very small, rather insignificant country to the world's dominant enterprise, has been the free market system and enterprise, innovation, creativity, virtue.
Right. The Industrial Revolution. Yeah.
Oh, yeah, absolutely. And he also has another comment. We often talk about money, and he says, "A dollar is not value, but representative of value, and at last, moral values." And he has a great section in the book, again, that shows you any culture that has a real lack of moral values and moral cohesion, lack of trust, lack of confidence in your institutions, all of these things, rule of law, and so forth, you'll find a dollar that is devaluing. It won't stand up. A country with a strong dollar, strong anchor in value over time will be one that is, again, infused with strong ethical and moral values. And I think this is really important for people to remember, that if we want to restore our currency value, we should look at the values of our civilization, our population, and say, hey, wait a second, where are we getting our value? And we kind of wonder, where are we going, and really what holds us together as a nation, as a people? What are the ethical values that we want to hold on to? Can we trust our neighbor? Can we actually enter into long-term contracts with confidence, and so forth? And so I think that that's something that, again, we as investment advisors and professionals need to go back and challenge the system. Where are our ethics? Where are morality, our morals? Are we anchoring them in the right place? And reestablish that. A secular or atheistic economy will not produce long-term wealth. And so we need to be innovative, creative. We need to think about our neighbor. We need to show love and compassion and entrepreneurship and think long term. Even as we go through some of these difficulties that we're experiencing now, we should always be thinking intergenerationally. What's going to be good for our kids and our grandkids? Not punishing our kids by overspending and running up our bills, but how can we actually create a better economy, a better world, a better culture for the next generation, and again for the one after that. So those are things that often we don't think about as much, but those are the things that ultimately are going to strengthen our economy and produce the wealth that we want to produce. If we just think of ourselves, then a selfish economy will ultimately go down, and we'll find our currency continuing to give up more and more value, which is what we're seeing with all of the printing of money and the debasement of currency, and not owning up to our own responsibilities now.
So I think this is a really important topic, and forgive me, I'm trying to pull up an image here. So let me see if I can do it in real time while we're talking. Yeah, there we go. So it's funny, I didn't know you had a theology degree, which explains why you're such a deep thinker and care so much about so many topics. It's sort of in my study of the world and all different types of thought paradigms and religions, et cetera. I do think there's this sort of common thread coming up, and you mentioned the word values several times. In my opinion, it doesn't really matter, which big deity in the sky, you believe is up there. It really comes down to the values that your belief system holds. And there was a great quote from Gandhi that I've repeated often on this channel, but I'll do it one more time. And that's what I'm pulling up here. It says, your beliefs become your thoughts become your words become your actions become your habits become your values become your destiny. And that last line of your values become your destiny, I think is exactly what you're saying, Jonathan. And it's funny because, we can see this play out in all eras of history, but we can even see it playing out in front of us right now. I just, in yesterday's weekly market recap video with Lance Roberts, I brought this up. You're seeing a tremendous amount of flight from New York State and New York City to other states right now, particularly Florida and Texas. And I put up some comparative data on the screen that just sort of compares New York versus Florida. And, on a lot of metrics, Florida just seems way more compelling. A lot of these are financial metrics. So, it's got, New York has some of the highest state income taxes in the country. Florida's got 0%. Cost of living index is substantially lower in Florida. Education cost is much lower, but performance is much higher. There's a whole bunch of things like that, right? And it's kind of like Gresham law, where bad money drives out good, right? If you have bad policies, eventually people will move to a place where the policies they think treat them better, right? And of course, the decisions we make, the policies we create, those are all determined by our values, right? Mm-hmm. And what I find really interesting about what's going on right now between those states in America is, you can look at it and say it's sort of a battle of the ideas between more free market capitalism versus more socialism and generous social programs, which New York is pushing more for. But you can also look at it as a really good current manifestation of federalism, which, as the founding fathers intended here in America, where they said, look, we're going to try to have a federal government that does the least. Now, of course, that has changed over time, but their vision was a federal government that kind of only did a few things, and then we'll let the states figure out really how to self-govern as much as possible, and we'll just have a whole bunch of running experiments. And at any given time, people can uproot themselves and go to a different state if that state they feel is treating them better. So again, I look at all this and just think it is the direct outcome of what you're talking about, right? If you have a set of values, one set of values, it's going to lead you to make a certain set of decisions. And over time, if somebody else has a different set of values that are leading to different decisions that the general populace says, I think that serves me better, we're seeing that it works. We're like literally seeing right now, pretty persistent outflows from one area and inflows into others for this reason of differences of values and differences of belief. So, of course, the other reason why I really liked why you brought this up was uh, I've talked about the importance of like knowing your why. Like at the end of the day, why are you doing all this, right? Why are you pursuing wealth? And why so many of the folks who watch this channel, you spend a lot of your time either creating the wealth, right? Slaving away at your job, or working to grow it through investing or things like that. It's something you think a lot about. You probably, spend an inordinate amount of your brain power thinking about how do I grow it or how do I not lose it. Why is it worth all that trouble, right? And it's not worth all that trouble just to have a whole bunch of dollars at the end of the day, right? It's because you want to be leaving a legacy of some sort in this world, right? You want to be providing for your immediate family. You want to be enriching life in the way that matters to you, spending time the way you want with the people that you want to spend it with, right? Those are all the things that are really important about, to really keep in the forefront of your mind, especially when the world gets kind of wonky like this, because there is no guarantee that you're going to come out through it okay. Now, this whole program is for us to talk about insights and strategies that will hopefully improve your odds of making it through it, as best you can financially. But as I like to remind people, look, there's no guarantees. The money can come, the money can go in life. You want to make sure that no matter what it does, you are still as rich as possible so that you've got this, the richest relationships in your life. You've got the most meaning in your life when you wake up in the morning. You've got good health no matter what the S&P does tomorrow, right? So it's keeping that why like really firmly in your crosshairs. You're nodding a lot as I'm saying this, so I'll hand the torch back to you. But that's a big thing when you were sort of talking about sort of the morality and the values that was coming to the forefront of my mind.
Yeah, I mean, what I would point out that you do want to make sure that you're rooting yourself in what is true. And of course, the big question is what is truth? And
Right.
that's we're going to have a big argument or a big discussion in terms of that. It's that vertical relationship that I think is important to have clear. And then once you have that vertical relationship right, then you can really have much healthier and stronger horizontal relationships. That then you know why you're here, what your purpose is. You've rooted yourself ultimately in eternity, and that's critical. Then it gives you a basis to interact on this world with each other and how we are to go about that. And so I think that the founders of the United States, they knew that they actually made it very clear that unless you had a virtuous and values oriented people, they wouldn't be worthy of the republic over time, right? You cannot run maximum freedom in a society without virtues and values and moral absolutes. And so these are things I think are really important. That freedom is not absolute. Freedom has to ultimately have a form. The issue is what form does it take? And so if you get into like you think of Florida and Florida and New York, I would argue that the economic policies being pursued by New York are a rejection of the created order. They stomp on the individuality of the importance of people, the value of people, and they take away initiative and creativity versus the policies of Florida are trying to reward people with maximum freedom to be able to operate as human beings. So, and then you'll see that one doesn't work and one does work. And that's the beauty of the system. I think it does correct itself. And so that's where if you spend money and you print money and you think that's going to produce wealth, doesn't work. Why doesn't it work? Because you have to work and you have to produce things if you're going to have any money to be able to transact in things. So that's what I like about ultimately the world of economics is you can only, try to get around reality for so long, and then it catches up with you because ultimately there are real values and there are moral absolutes that you have to abide by. And if you don't, payday will come. And I think that's what we're seeing a lot in the Western world, where we sort of jettisoned long-term discipline, frugality, investing for the long haul, family formation, children, another generation, investing, kids, grandkids, and so forth. But that comes at a massive cost to our society and to our culture. And I think that's what we're facing now. And we're seeing that now embedded in our politics and in our economics. And
Yeah.
we need to, again, think about these things, as you say, think about why we're here, what the purpose is, and make sure you've got a good reason. Otherwise, when things get tough, you can't take it otherwise. You're going to be strong and robust. You have to have a strong worldview that you can anchor yourself in. Yeah.
Yeah, very, very, and that word anchor, I think, is really important. So, great conversation here, Jonathan. My parting bits of advice to the audience here is, um, whatever your persuasion, whatever your particular, faith, lack of faith is, hopefully there's something in this conversation that's resonating with you, and recommend that you maybe spend some time, this weekend just reflecting on values. What are the values that you personally hold highest? And ask yourself, okay, am I living in accordance with them? And if I'm not, and none of us is perfect, where I'm out of alignment, what can I do to begin to bring my actions better into alignment with those values? And then similarly, ask yourself, those of you with families, what values do I want my family to embrace as well? And my guess is there would be your personal ones, but there might be some additional ones given the family structure. And then make sure that everybody in your family, is on board with those. And a lot of times we just sort of assume and all this stuff's unspoken, but sometimes it's actually good just to put it on the table and say, hey, as a family, I think this is what our key values are. Do we all agree? If we differ, why? Let's talk it through. But hopefully, try to get your family a little bit more mindful about following your lead as well.
Yeah, the family unit, the most important unit in society, Adam, and you'll find that nations that have strong families have small government. Nations with weak families have large government. The family unit is the strongest bulwark against totalitarianism, and so it is a major investment and incredibly important to invest in our families, our children, and the next generation. And there's nothing really more important in terms of driving an economy, a society, and a civil population that knows how to get along with one another. The family is the university of life. That's where you learn all of your basic principles, moralities, and ethics in the home. And so, yeah, your encouragement for people to invest in the family and think about that is 100% accurate.
All right, thanks. And look, if you're a younger person watching, obviously you're part of a family, have these conversations with your family, but I also would say look to people around you who are older, who you think are really doing it well, and ask them, what are your values, and find out what they have in common, and if that's something that wasn't already on your list, consider adding it there. All right. I didn't expect us to get so metaphysical, but it was really fun to do that today, and I think it was very worthwhile, especially in such a chaotic time. Thanks so much, Jonathan. So folks, first off, please thank Jonathan for giving us such a great conversation today by hitting the like button and then clicking on the subscribe button, as well as that little bell icon right next to it. As a reminder, Jonathan is Thoughtful Money's he's the head of Thoughtful Money's endorsed financial advisor up in Canada, Rocklinc Investment Partners. If you would like to schedule, if you're Canadian and would like to schedule a consultation with them, you can do so, and I'll tell you in just a second. But also, if you're in the US and you'd like to talk to one of our US advisors as well, this guidance will apply to you as well. Just go fill out the very short form at thoughtfulmoney.com. It'll only take you a couple of seconds. And once you do, the firm that you get matched with will reach out to you right away, and you can have one of the free consultations that they offer. As a reminder, these consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. And if you are a Canadian, don't forget when you're filling out the form where it says country of residence, click Canada. And if you do, you'll be connected with Jonathan and his team there. Lastly, too, if you missed the conference that we just had yesterday, but would like to watch the replay of it, just go purchase the replay over at thoughtfulmoney.com/conference. Thanks so much, Jonathan. Great to catch up with you. I'll let you have the last word here.
No, thank you very much, Adam. It's always wonderful to speak with you. Thank you for the work that you do, and the wonderful speakers they have on. As I told you before, I listen to probably 60–70% of the sessions, and find them incredibly valuable, and integrate many of the ideas into our own business and practice. So keep it going. The specialists that you have are fantastic, and it really helps.
All right, thank you. And for the folks who are saying he only listens to 60–70%, it is an 11-hour event, folks. So that's 6 to 7 hours he's giving up on his Saturday. So he's still making a big contribution there. All right, Jonathan, thanks so much.
I'm talking about your ongoing programs all the time. I'm listening to your day after day after day.
Oh my goodness.
And enjoy them. And you have tremendous speakers. And so I really appreciate it. I'll listen to all of the speakers eventually on the replays that you're going to have on the conference.
Wow. Well, thank you so much. And look, I know what a busy life you lead, and the fact that you listen to that many on a regular, ongoing basis is a huge honor. So thanks so much, Jonathan. All right, great conversation. And Jonathan, I'll see you again soon. And everybody else, thanks so much for watching.
Russia, China, and now India. You know, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system.
The trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by. I don't. $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond.
Central banks, especially in India, Russia, China, and other global South nations, are boosting gold reserves while cutting U.S. treasuries, marking the first time since 1996 that gold has surpassed treasuries. India alone has reduced its T-bill holdings to $227 billion, while raising gold reserves to about 880 tons. Meanwhile, Eric Jung predicts that with gold hitting record highs above $3,500 to $3,600 per ounce, forecasts project $3,700 to $4,000 by mid-2026 and potentially $5,000 plus if Fed independence is challenged and a wider shift from treasuries accelerates. So the U.S. can revalue its treasury gold reserves at much greater market levels. Eric Jung is a financial commentator and analyst who frequently discusses gold, silver, and macroeconomic trends. He highlights that gold consolidated for months before breaking above $3,500, while silver pushed past $40. Many dismiss the idea that Trump's tariff threats explain this move, since that narrative has been recycled for months. What really drove the breakout was the recent BRICS meeting and India's shift, reducing U.S. Treasury holdings while increasing physical gold and silver. Combined with America's ballooning $37 trillion debt and talk of confiscating frozen Russian assets, these pressures pushed India further toward hard assets and away from treasuries. This reflects a much larger global trend. Countries like Russia, China, and now India are abandoning U.S. treasuries and adopting physical gold as a reserve asset, signaling a fundamental change in the financial order. Unlike treasuries, which can be frozen or seized by Washington, physical gold held at home cannot be cancelled by a foreign government. Eric believes as a result, sovereign demand for gold is accelerating. For additional information, view the video. Please subscribe and like the material if you enjoy it to receive the latest updates.
Gold, I think, consolidated for around 5 to 6 months, and it broke out of 3,500, so $3,500 US dollars per troy ounce, and silver went beyond $40. I think that was the top it made several months ago. So it's now above $40 US dollars per troy ounce. And I know the mainstream narrative of all this is that the tariffs, the Donald Trump tariffs, potential tariffs on gold and silver is not clarified, but I don't buy that because they've been using that narrative for over 6 months. How stupid do they think the authorized participants are? The bankers are, right? This is ridiculous. I think what really happened is BRICS happened, like that BRICS meeting that just happened, and what happened in India. I don't know if you know, Danny, but the Indian central bank is now reducing their U.S. Treasury bonds and T-bills holdings and increasing gold, physical gold, and guess what? Also silver, physical silver holdings. Okay, that's why I think, in my opinion, that's why gold and silver broke out of their trading ranges. Donald Trump, but it's funny that it just seems that nothing that India does pleases Donald Trump. And Donald Trump came back with a 100% or more tariff on India. So I don't know. I think it's as simple as that. It's just like somebody is trying to be nice to Donald Trump, and Donald Trump instead slapped additional tariffs on that country, and therefore that country is pushed over the edge. And now, they are reducing officially their U.S. Treasury bond holdings. But I think the underlying reason, Danny, is we've said this before. Two things. Number one, look at the U.S. national debt, $37 trillion and counting. $1 trillion of additional debt every 3 to 4 months. Okay, so this ain't going to stop. Number two, recently the EU is supposedly potentially going to be pushing the button to confiscate the frozen Russian assets. Okay, that they froze, when Russia started that special military operation in Ukraine. So I think combining all these different, factors just really gave India the extra push to push that button to let go of the U.S. Treasury bonds and T-bills and dive in officially into gold and silver. Then recently, gold just shot up and exceeded U.S. Treasuries. So, I know a lot of people make fun of this, but what that tells me is that, led by the global South, Russia, China, and now India, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system. Because going forward, I don't see there's any, significant steps of this trend in reversing. Simply because in a multipolar world, physical gold is not controlled by any individual country. Nobody can just push a button and cancel the physical gold that, let's say, India, China, and Russia hold at their, domestic vaults. Okay? But, let's say if you hold a lot of US Treasuries and you piss off Uncle Sam, somebody like, I guess Bessons or Jerome Powell, whoever, can go back to the office, push a button, and buy. Your stuff is frozen, or worse yet, it's going to be confiscated, or deleted, or whatever, right? So I think, like I said, the flight to physical gold at a sovereign level is not going to stop. It's simply going to accelerate. And physical gold, like Francis was saying, is just at its beginning phase of being remonetized. And it's going to accelerate going forward.
Francis Hunt, known as the market sniper, along with Eric Jung, points out that central banks remain steady net buyers of gold, with India notably reducing U.S. Treasury exposure while increasing its gold reserves over the past year. Analysts warn that even modest reallocations from treasuries into gold, potentially in the hundreds of billions, could drive prices sharply higher, given tight liquidity and the outsized impact of institutional flows. Forecasts suggest gold could reach $3,700 by end 2025, around $4,000 by mid-2026 in base cases, and near $5,000 in stress scenarios, expanding its market cap from roughly $24 trillion to over $31 trillion. This shift is driven by geopolitical tensions, rising U.S. debt, and concerns over dollar-based assets being frozen or seized, making gold the preferred non-sovereign reserve asset as nations diversify away from treasuries. Let's just get back to the interview.
What percentage of that is losses in treasuries as well and gains in gold? which further eggs the point rather than saying that there's no one selling. But people don't like to accumulate an asset that is losing value, and they double down and accumulate assets that for the extended future they see as accumulating value. No one gets fired for buying gold or for hiring McKinsey, they used to say. I don't think central bankers, and it also puts something else. I'll throw two other thoughts in on that chart, which I love, and I'm glad you shared it. I saw it as well. There's no chart for it, but I can tell you those nations that are accumulating and also seeing appreciation in their gold whilst not adding to their treasuries and watching devaluation, they're also not choosing Bitcoin. They're choosing gold. They're choosing gold predominantly here. And that tells me there's a very Americanized probable stigma in terms of the potential creation, because there's been no embracement by institutional central banks in the Deep South or the Grand South or the Global South and the BRICS nations in terms of Bitcoin on a meaningful basis. They accumulate it where they have a criminal who's trading in stolen cars or something, right, fine, and they hold it. But there's not a net accumulation on that side as well. So I think when you look at the big money that knows, the big money has spoken and the winner is gold. And the appreciation will be far more safe in a less volatile way, and you won't have to watch an 80% cycle deval or 75% one if you miss the perfect selling point either. And people need to remember those key aspects about Bitcoin and gold, and why I think gold is the winner. It's the safe hands for everyone. Yeah, in terms of the market cap as well, again, because don't forget $1,500 extra on the gold ounces. That's actually in percentage terms from 3.5. It's almost like another 50%. It's probably around whatever, 35 to 40%. So you would go from 24 trillion plus another third. You'd add another 8 trillion on that, and you'd be at 31 trillion. So I don't, $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond 50 and beyond. Eventually, my feeling is that whatever the debt market was at its high point, the amount of money we felt existed at its biggest bubble of the debt market, we end up seeing that deflate, and by however much that deflates, gold goes up, because there's really only one trade for me. What do? You don't buy real estate that's already leveraged with debt at ridiculously high prices. You don't chase a hyper overvalued record PE stock market. Some people will, and there will be elements. But when this is fully played out, the natural approximate geometry is however big the trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by.
The accelerating move by central banks, especially in India, Russia, China, and other global South nations, away from U.S. treasuries and into physical gold signals a historic reshaping of the global reserve system. With gold breaking record highs and forecasts pointing toward $4,000 to $5,000 in the coming years, the metal is regaining its role as a core anchor of financial security, driven by sovereign demand, geopolitical uncertainty, and distrust of dollar-based assets. Could a mass revaluation of U.S. Treasury gold reserves at higher market prices fundamentally reset the global financial system? How might continued BRICS diversification into gold and silver impact the long-term dominance of the U.S. dollar? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will, then we're going to see some real fireworks. But it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Asia, not the West, has been the primary driver of gold's latest climb, which has fueled a 48% increase this year. Asia is currently leading the rebound, but it might take off when investors from the US and Europe join in. Goldman Sachs has warned that gold may increase to $5,000 if the Fed's independence is undermined. Such forecasts are perceived as reliant on robust investor flows, which erodes trust in conventional safe havens such as the dollar and Treasury securities. Mike Maloney, a precious metal expert, argues that $5,000 gold is far too low, especially if Trump undermines the Federal. Big names like John Paulson, J.P. Morgan, and Goldman Sachs now call for $5,000, but critics say that figure ignores today's massive debt and weaker dollar. Gold is up about 40% this year, with expected continued gains driven by the weaker US dollar, Fed rate cuts, geopolitical risks, and increased demand from central banks and ETFs. A correction of 5 to 6% is possible, but many expect gold to top $5,000 per ounce in 2026. Historically, even a small wave of investors piling into gold can trigger a rush from stocks and real estate, sending prices soaring well past $5,000. For now, analysts note that Western institutions are beginning to increase exposure to gold via ETFs and other channels, which could trigger strong upward momentum once that catch-up demand intensifies. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think actually it's if Trump undermines the Fed, with gold, 5,000 is a ridiculously low price. It's just stupid, idiotic low. You have to put a 1, a 2, maybe even another 5 in front of that 5,000. But the very fact that they are saying this, and John Paulson just said $5,000 an ounce, and J.P. Morgan just said $5,000 an ounce, and people are reading it. So Goldman Sachs has finally woken up. I was saying, my analysis in my first book, I had 3 different ways of looking at it, and I came up with a range of the low 6,000s to the mid 6,000s. But that was back then when the debt was so small, and when the dollar was, in a much better position. But the main thing here is that Goldman Sachs is writing positive stuff about gold. They were so negative on gold when gold was $700 an ounce, $400 an ounce. That's when, no, you don't want any gold. You want what we sell. Now, gold has proven them so wrong. All these people, J.P. Morgan, Goldman Sachs, they are so incredibly wrong year after year after year. And now they're jumping on the bandwagon here because they're looking like idiots. But the fact that they are saying this, even if Trump does nothing, could cause gold to go to $5,000 an ounce. If Trump does something that undermines the Fed, $5,000 an ounce is an absolutely idiotic prediction. It is absurdly low. First of all, if anybody that bought the Great Gold and Silver Rush of the 21st century, and they've read the chapter on Giffen goods and about the panic that happened back in 1979, first month of 1980, and then the differences between the bull market of the 70s and today, if 1% start going toward gold and it goes toward $5,000 an ounce quickly, then 2% are going to go, 3%. And then there's going to be a rush of a whole bunch of other people where it's not treasuries that they're selling, it's other things that they're selling. It'll be stocks and real estate, and everybody starts to gravitate toward the thing that's going up fastest, toward the thing that is the ultimate safe haven investment, especially in turbulent times, war, all of this stuff, when the public comes rushing in, and they're not right now. The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will, then we're going to see some real fireworks. But right now, Asia has lit the fuse, and this is part of lighting the fuse. Goldman Sachs writing this stuff, JP Morgan writing this stuff, and big successful investors like Paulson writing this stuff. Now that it's getting out into common public knowledge, but I want to, again, my predictions on this were 17 years ago. And it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Mike points out that while Asia is driving today's gold rally, the rise might become explosive if the United States and other Western countries join in. Gold's rise is driven by forecasts of U.S. rate cuts and declining real interest rates, which make it more appealing as the currency depreciates. Demand for safe havens is increased by the OECD's warnings about stagflation dangers and negative real rates. The surge is being driven by Asia, but Western investors are starting to follow suit, which might increase gains even more. However, after Nixon terminated Bretton Woods, gold first increased under positive rates in the 1970s. However, the real boom was powered by negative rates once Americans and Australians were permitted to purchase. According to Mike, the official CPI may be understating inflation in comparison to today. The use of shadow statistics from pre-1980 techniques indicates that we are already in negative real rate territory. These circumstances could work as gold's rocket fuel, indicating substantially greater prices to come, especially with rate reduction on the horizon.
And we're already going north because of Asia. And if we start buying, Asia is good. Now, I want to remind everybody, if they really need, a lot of people viewing this have read The Great Gold and Silver Rush of the 21st Century. But in the first bull market in the 70s, it was a very small percentage of the world's population. It was like 5% for the first half of the 70s. And then from 75 to 80, it was about 10% of the world's population. This time, it's that same percentage plus all of it. I mean, it's everybody except North Korea participating this time. And so it's complete. When people say, oh, this time it's different, with gold and silver, it's the only time that statement is true. This time it is different, really different. Oh, you'd have gold price, rates, and the CPI to create the negative real rates. So you've already got three, but add one more column of the shadow government statistics, alternate CPI, which I keep on reminding people, it's not like conspiracy theory stuff. It is government numbers. It's the CPI as used from World War II to 1982. So it's just the way the government used to measure consumer price index, and make, you've got red. It would be good to add some more stuff. So you need colors, but remember, people that are color challenged, it's red, green. So you don't want to use both those colors on the same chart. But I want to point out, the first half of the 70s bull market, we were in positive rates. But that portion of the gold rising was from the date that Nixon took us off of the Bretton Woods system, but it was still illegal for Americans to buy gold. It was only Western Europe and Canada participating. Australians couldn't buy. American citizens couldn't buy. There were no markets in the USSR, so everything inside the Iron Curtain, all those countries, China under Mao, they could not participate at all. And so that was the only area during these red boxes that you've pointed out where it's predominantly negative interest rates. Once the US joined the party and Australia joined the party in the 70s, which happened the first day of 1975, we were in this negative real rate territory, and we stayed there until gold peaked. And the second that they cut rates, we are in that negative real rate territory. We're it doesn't show us being in it right now, but we probably really are. I would love to see this with shadow government statistics, alternate CPI. And we might want to do a column that averages the two, because I do think the truth lies somewhere in the middle of the old government numbers, the original CPI, and the new CP lie. And so it'd be neat to have our own inflation indicator, the goldsilver.com inflation indicator that's just averaging the two, previous government numbers, new government numbers.
Could gold prices swiftly rise beyond $5,000 and reach far higher levels if Western institutions greatly increase their exposure to the metal? Is this gold cycle essentially more robust than the boom of the 1970s given the current low real rates and high debt levels? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
We've got gold at 34.82, the spot price. It's up 35 bucks. So it looks like the breakout that we saw last week is being confirmed. You never know in the short term what could happen, but you need to hold on because this is the end game for fiat currencies, in my opinion. I don't know how long it's going to take. It could be months, it could be half a year or a year or two, but it's going to get very turbulent, in my opinion. So yes, gold and silver continue to trade really well, and what's happening is fiat currencies are dropping really. That's what's going on, and we got spot silver actually breaking through 40. Not that 40 was a key resistance, it was more of 39.50, but we are at 40.56 this morning, up 2%.
Gold surged to about $3,482, its highest in over 4 months, on Fed rate cut bets and a weaker dollar, with futures touching $3,500. Silver topped $40 for the first time since 2011, supported by tight supply and easing expectations. Analysts point to strong central bank buying, monetary policy shifts, and geopolitical risks as key drivers. HSBC projects silver to average $35 per ounce in 2025 despite dips, warning of a major supply deficit. Many see silver entering a potential supercycle, fueled by industrial demand, shrinking inventories, and its growing role as a monetary asset. While short-term moves are uncertain, the speaker, Mario Ineco, believes this marks the endgame for fiat currencies, which could unravel in months or a few years, bringing turbulence. He explains that gold climbed to a more than 4-month high, reaching approximately $3,486.86, buoyed by increasing expectations of a U.S. Federal Reserve rate cut and a softer U.S. dollar. Dovish commentary from Fed officials and legal setbacks for U.S. tariffs further weakened the greenback, propelling gold higher. U.S. gold futures also moved up, touching $3,554.60. Silver broke above $40 per ounce for the first time since 2011, rising 2.2% to about $40.56. Expectations of imminent rate cuts remain high, with the CME FedWatch tool indicating an 87% probability of a 25 basis point cut. This outlook boosts demand for non-yielding assets like gold and silver. To ensure you stay informed, please subscribe and turn on the notification bell before we start. Please leave your ideas in the comments section, we'd love to hear them. If you're enjoying the video, don't forget to like it.
This is the end game for fiat currencies, in my opinion. I don't know how long it's going to take. It could be months, it could be half a year or a year or two, but it's going to get very turbulent, in my opinion. So yes, gold and silver continue to trade really well. And what's happening is fiat currencies are dropping, really. That's what's going on. And we got spot silver actually breaking through 40. Not that 40 was a key resistance, it was more 39.50, but we are at 40.56 this morning, up 2%. Gold is up 1%. The Dow, S&P, and NASDAQ futures, they're down very slightly, so it's fairly quiet, not surprisingly. I've noticed, though, that the 10-year JGB yield, that's made a new high. It's the highest level since 2008. We're at 164. And I was just reading about a 2 trillion euro Dutch pension headache is coming for European bonds. So the Dutch pension fund managers, they're going to divest hundreds of billions of euros out of the longer end of the bond market, bonds like 10 and 30 years. And we know that in Germany, US, UK, and Japan, these yields are going through the roof. Yes, they're still under control, but what are government bonds? Well, they're just fiat currencies that are due for their loans in fiat currencies that are due in a certain amount of time. And as the system implodes, the fiat currency system implodes, so will the bond market. Yes, the central banking emperors might conjure up some trillions of dollars to buy those bonds, to monetize them. But all that will do is it will be more gasoline. It will throw more gasoline into the fire. It will just accelerate the demise of fiat currencies. Gold is the ultimate form of international payment. Well, we're seeing that, aren't we? Why are BRICS loading up on so much gold? Well, because the dollar system is going the way of the dodo bird, the dollar payment system, for that matter. And we saw over the weekend that President Trump was able to help BRICS. How did he do that? Well, the relationship between the US and India went down the drain. So now India and China are new buddies. They're part of BRICS, but it was always a little difficult relationship. So that's going to accelerate things even more in terms of countries loading up on gold and using the dollar less and less. Second part is gold is a barometer of fear and confidence, not inflation. Well, that's true as well. There's a lot of fear right now, and the confidence in the system is buckling, I would say. Gold is a measure of geopolitical power. Well, yeah. He who has the gold makes the rules, right? It looks like that's shifting, well, in relative terms, a lot more away from the United States to the BRICS. Am I for the BRICS? No, I'm just trying to tell you what's going on so that you can protect yourself, hopefully financially. This is a really good one too here, because we're seeing this and we're talking about this, right? Gold is a measure of government debt and the willingness to repay such debt. Well, there you go. One of the reasons gold is going up now is because bond investors and Dutch pension fund managers realize that the payment they're going to get in 5, 10, 20, 30 years, it's not going to be with the same, well, it is the same currency, but this currency will have not the same purchasing power as it has now.
Mario points out that gold exposes falsely stated wealth by showing the gap between inflated asset values and real purchasing power. While deflationists expect a collapse in fiat terms, central banks can always print more money, creating the illusion of rising values. In reality, this erodes wealth for the majority, especially the bottom 90%, who lack significant assets and must bear the burden of falling living standards. Overstated expectations, whether in stock markets, social guarantees, or government spending, ultimately translate into higher costs for ordinary people. Much of the supposed wealth tied to real estate, equities, or pensions is based on debt and speculation rather than lasting value. As inflation outpaces wages, citizens are left paying more for essentials while being saddled with government debt from decades of mismanagement. Gold and silver serve as reminders of what real wealth is, revealing the truth behind currency devaluation and political promises. In the end, the public absorbs the cost of financial excess through reduced purchasing power and rising living expenses. Now, let's move back to the interview.
Gold is a revealer of falsely stated wealth. So there you go. And I think that's where the deflationists get it wrong, because they expect to see a deflationary collapse in fiat currency terms. But the problem is that the central banks and the governments can always ramp up the printing press and make sure that those values go up. But in real terms, of course, as I said earlier, we're having a deflation. So let's go through gold is a revealer of falsely stated wealth. Gold is a revealer of falsely stated wealth. Let's get to it. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. Well, what comes to mind when I read this is the fact that stock market capitalization as a percentage of GDP, which is a measure Warren Buffett likes, it's at all-time highs, like 210%. Anyway, that depreciation is borne by the citizenry. Yeah, the bottom 90% who don't have many assets, who are forced to lower their living standards to compensate for both personal economic mismanagement as well as the mismanagement of the affairs of state. Well, we know all about that, don't we? Financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate, equities, affluence. As expense runs out of control, well, that's deficit spending, guarantees to the citizenry also explode as politicians seek to retain the privilege of office. Yeah, inflate or die, right? A big, beautiful bill. But the promises of wealth are false. The belief that ownership of real estate is a ticket to fortunes is hollowed out for what it is, a myth. And I would add, though, that having real estate over the long term, over generations, is a good way to store wealth. I think what they're talking about here is rampant speculation and borrowing to try to make money through real estate. Wealth that was taken for granted suddenly appears ephemeral. And I think that's what gold and silver are warning us. And it's also warning us that the central bankers and governments, they're not going to allow for the deflation in fiat currency because they're fighting for survival. So what gold and silver are going to do, they're going to reveal what real wealth is. The amount of currency which one bought certain things no longer does. But wages have not risen along with prices. Yeah, we know all about that too. Instead of wealth, citizens get saddled with a big chunk of government debt, i.e. debt created by mismanagement. The result is everyone pays for more for food, fuel, and other basic necessities. Government passes on the mismanagement of economic affairs to its citizenry by devaluation.
Gold and silver are acting as both safe havens and truth tellers in a fragile financial system. They reveal the weakness of fiat currencies, the unsustainability of debt-driven promises, and the erosion of real wealth for ordinary citizens. As central banks and governments struggle to maintain control, precious metals continue to highlight the widening gap between inflated paper assets and lasting value. Do you think more people will turn to gold and silver as trust in fiat weakens? How might rising demand for gold by nations like those in BRICS reshape the global financial order? Kindly leave your opinions in the comments section below. We would be delighted to hear them. Please remember to subscribe for more videos and give this one a thumbs up if you thought it was helpful. We appreciate you going on this journey with us.